The stock market is about to move on chain. This doesn't mean synthetic wrappers, it doesn't mean derivatives, it's about actual SEC registered shares that you would find on NASDAQ.
2025, in a lot of ways, like the firing gun that set off the tokenization race. A year ago, if you asked them, like, are people going to tokenize equities? Every single one of them would have said, like, huh? No. If you ask those same institutions today, 100% of them say, this is the future, it's inevitable.
What's the gap that you're closing in the market?
What we needed and what we need is the $700 trillion of stuff, of wealth, of assets, of ownership to make its way on chain. And if that happens, the upper bound of DeFi is like $700 trillion.
Welcome to another episode of 51 Insights. Today with Robert Leshner. Robert, welcome to the show.
Thanks for having me.
Robert is the co-founder and chief executive officer of Superstate. Superstate is one of the leading tokenization platforms. We'll talk about this later in much more detail. But the stock market is about to move on chain. This doesn't mean synthetic wrappers. It doesn't mean derivatives. It's about actual SEC registered shares that you would find on NASDAQ. And Robert, you first built Compound into one of the largest DeFi protocols in history. Then you walked away to build the infrastructure layer for exactly this. And in this conversation, we're going to dive into your Invesco deal that you just recently announced and why companies' public shares are already being posted as a collateral on the Solana lending protocol, and many, many more details on Superstate. So welcome to the show. Super excited for this discussion.
Yeah, excited to dive in.
Robert, back in 2023, when you left Compound, you went on the record saying institutions aren't coming to DeFi to trade. They're coming to put their assets onto blockchain rails. 3 years in, how do you grade that call?
Pretty good. I'm going to go with pretty good. Right now, 3 years later, we're starting to see a lot of examples of people being engaged in the security tokenization lifecycle, whether they're issuers, whether they're people, purchasing the assets, whether they're intermediaries that are supporting different types of activity. We're starting to see a lot of tokenized security. My original comment 3 years ago is the institutions aren't coming, and I think I said it in the context of they're not coming to buy your protocol tokens and crypto tokens. They're not coming for crypto native assets. They're coming for the off-chain assets on chain. And I think that's playing out pretty well. I mean, not to, kick anything while it's down, but the crypto market right now has been struggling, right? The institutions are not coming in droves to buy everybody's L1 tokens. They're not buying their protocol tokens. There's been a lot less of that than I think people have hoped for. So I'm going to give my comment pretty good accuracy rating. Let's go with a B+ or A-.
Yeah, that's actually really interesting, and I agree with you. Investors didn't come for the actual tokens. They came for either the underlying infrastructure, the application layer. Right now, if you look at the market, it's definitely not for the tokens.
Right, but it's really happening. The institutions are coming here. They are starting to use blockchains, and it's amazing.
Can you give us the elevator pitch of Superstate? What's the gap that you're closing in the market?
Yeah, the gap that we're closing is simple. There's a lot of securities, whether it's stocks or bonds or other things that, exist in finance that aren't currently on blockchains, that exist in spreadsheets and databases and paper contracts and all of these other things. And they're just not tokens yet, right? And from the perspective of a DeFi founder, right, I was like, the ceiling for DeFi is too low if all we have are crypto native tokens of other crypto projects. The upper bound can only get so big. What we needed and what we need is the $700 trillion of stuff, of wealth, of assets, of ownership to make its way on chain. And if that happens, the upper bound of DeFi is $700 trillion, right? If that doesn't happen, the upper bound of DeFi is the same as it was in, 2019, roughly. And so the pitch for Superstate is really simple. We're trying to make it easy for those assets to move on chain. Under the hood, it's complex. There's a lot of financial plumbing. There's a lot of policy and regulatory and legal work. There's a lot of operational work. There's a lot of technology work. There's a lot of things that have to happen for something as simple as saying we took a stock and we put it on a blockchain. There's a lot of moving parts, but we're at the point now where we take the stock and we put it on the blockchain. We take the fund, we put it on the blockchain, and it works.
What does that actually mean when you say we put a stock on the blockchain? Because there are a lot of problems that need to be solved with that, right? And just having a tokenized wrapper is not enough. right?
That's right. There's a lot of problems that need to be solved, and there's a lot of different approaches to solving those problems. So, the approach that Superstate uses is that, we partner with a public company. We do this as the public company's transfer agent. A transfer agent is this, type of entity that records who owns the shares of a security. And in doing this, we basically say, we're keeping track of the issuer shares. We're keeping track of them in databases. We're keeping track of them in ways that can, move inside the DTC and continue to trade in brokerage accounts and on traditional exchanges like the NASDAQ and NYSE. We're doing it in ways where it can do all of that, but the shares, the official shares of a company, can be recorded as tokens on a blockchain. And, this is a record-keeping difference, right? This is not a, functional difference of different economics, different rights, different characteristics. What we're doing at the end of the day is we're saying the share that a company issues can do all the things it's used to doing, but can also now be extensible to interact with DeFi protocols, on-chain investors, and new systems entirely. And so, when you really boil it down, what we're doing is we're saying there's a new option for how shares can live. And this is a really clean option, right? What it means is that the token on the blockchain is the same share of a company as the one that's trading on the NASDAQ. And you can actually bridge shares back and forth between those two systems. You can take a share in your brokerage account and you can move it into token form on Solana or Ethereum. And you can take a token on Solana or Ethereum and move it into a brokerage account. It's a really cool two-way bridge. There's other approaches out there, right? Like the easiest way to make a token on a blockchain is hey, this is not going to be the company's official share, but we'll buy some shares and we'll hold them in an account and we'll issue a claim against those shares that we as a startup or we as a third party hold. That's the most popular alternative, right? There's advantages to that. I like that approach for how quickly you can spin it up. There's disadvantages. It's a slightly different asset. It's not the same as the company's official shares are just recorded in a token. And so I think what we're starting to see, early on in this tokenization lifecycle is there's going to be different approaches. I think there's going to be a market for many of them. I think you can have a situation where there's a company's official shares and there's also wrapper tokens that people have made. A lot of the wrapper tokens are in some ways, interesting because they're being issued offshore and they're not being issued to US investors and they're permissionless and they're freely transferable. And there's all of these things that official shares are not, right? Official shares, can feel a little bit burdensome. It's you have to be KYC'd and you have to, be on the company's books and records and all of these things. There's a lot of different experimentation that's happening, and I think it's going to bear fruit in multiple different ways.
And if you compare Superstate to some of the other tokenization players like Securities or Ondo, do you differ in how you approach the tokenization part?
Tokenization, when you look at the process of creating a token, is actually one of the things that's going to be similar in multiple different approaches, right? So, at the end of the day, whether you're, Circle, who's minting and burning USDC, whether you're Superstate, who's minting and burning, a security token, whether you are, a crypto project with a crypto native token that has an adjustable or elastic number of tokens. And there's a process to create and destroy those tokens. At the end of the day, you have in general, an internet and blockchain connected computer or server or wallet or, process to make tokens and to destroy tokens against some source of truth. How many should there be? Why should there be that many, right? Run the processes to create on-chain transactions to make and destroy tokens, right? That mechanically is not that different. This is also one of these things that's been tested for, we're coming on 10 years now, right? Of making and destroying tokens. The difference and what makes tokenization is that that's really synchronized to something else, right? It's synchronized to how many shares of the company exist, or, how do we, increment the number of shares on a blockchain when we decrement the number of shares held in an off-chain system or in the DTC or somewhere else, right? Tokenization, making tokens, is not new. Using it for securities at scale is relatively new.
And when you look back over this 3-4 year history now with Superstate, what are some things that you are looking back on and you think this was exponentially harder than we thought it would be, and some things that were much, much easier.
When I found Superstate 2.5 years ago, frankly, at that time, it was a very different, U.S. regulatory structure. So I found the Superstate, in hard mode, which was founding a company in the U.S. to tokenize U.S. securities in the Gary Gensler SEC era, right? When they didn't want to allow anything through the front door. And part of this was saying like, hey, we just want to be there early before the door opens, right? Because like, whether it's a coin flip or what, like, I knew at some point things had to change for the better. And so, that was extremely risky. When we started out, we were like, hey, we're going to stick to tokenizing a money market fund, the simplest, least controversial product, right? That like, it doesn't matter how wicked the SEC is, like you can't argue against it. Tokenized T-bill at the end of the day, right? Like it's such a low risk, safe and useful product. And so, I didn't know when the door would open, so to speak, right? It could have been 2028, frankly, right? It could have been at some point in the future that wasn't, honestly, like early 2025. But 2025 was in a lot of ways like the firing gun that set off the tokenization race, right? Up until that point, we were able to start proving things out, and building a lot of infrastructure. But, the thing that has surprised me is that like equity tokenization has accelerated from actually zero. Like, I mean, like a cold start. I mean, there was zero activity on the tokenization of equities, prior to like early 2025 to it just being a flat out race. To figure out how to tokenize equities, to put it into practice, to go through the legal side, the technical side, the issuer side, like all of these nuances. The game, really began out of nowhere suddenly. And that was surprising. And like what I'm surprised at as well is just how far, not just Superstate, but the industry as a whole has come in basically 12 months. It's actually incredible. And I'm not just speaking for startups. I'm also speaking for like, traditional institutions too. Like a year ago, if you asked them, like, are people going to tokenize equities? Every single one of them would have said like, huh? No. Like if you ask those same institutions today, 100% of them say, this is the future. It's inevitable. And we are trying to make, our organization a big part of it.
You mentioned that a tokenization race started in 2025. When you talk to big corps about tokenization today, and I would assume like pretty much every major bank in the US has realized that this is a thing they need to look at, right? How are these conversations going? Do people understand this concept?
I don't have to preach to the choir, right? Like at this point, I think most institutions in financial markets understand the advantages. Do they understand like the nuanced details of like why the token is better and how it works and how a DeFi protocol works and how it can be transferred as collateral? No, sometimes they don't know all of the details, but they know that fundamentally there's a big market here, right? There's at this point about $300 billion of like investment / stablecoin assets on chain looking for, homes, right? There's demand. Like it's not like starting from zero. There's hundreds of billions of dollars of demand right now. So they get that. And they get that there's new use cases. Like they can see tokenized securities being used as collateral in a DeFi protocol to borrow against. They can see it being, sent around to like, centralized intermediaries in token form as collateral. They see it flying to like crypto prime brokers and like trading desks. They can see tokenized securities, work in different ways that have never functioned in historical markets. Like just something as simple as transferring shares between two parties is just clunky in traditional markets, right? But transferring it between two wallets, it's trivial. It's like one click, And so people can start to see that there's, significant benefits here. They're going to understand those benefits more and more and more every single quarter, But a lot of these organizations work in quarters. They don't work in weeks like, startups do.
And where are we right now on this tokenization race? And where do you think this is going? And what will be like the biggest unlocks in the next couple of years?
Yeah, I'll use a sports analogy, even though I'm not, that good at sports analogies. I really think of this as like the bottom of the second inning, right? In a baseball game. Like it's a long game. Like the score, whatever is on the board right now, doesn't really matter. Everyone's just getting warmed up and getting a feel for all of this stuff. And the game's going to be decided a little bit out. But every single inning counts, and every at-bat counts, and every single day counts, and every single action we take counts, right? I think it's too early to judge who's winning and losing. I think there's a lot of incredible progress that's been made. There's a lot of great experiments so far. There's a lot of great traction. There's a lot of great products, but it's just so early. And the reason I say that is just, there's $300 billion of potential market right now. On chain, I think eventually we get to the point where there's 700 trillion of potential market where everything is on chain, the whole thing, right? And that's, it's 2000x our current market potential in a lot of ways. And that's when things get big, and that's when every institution is fighting for it. And that's when the numbers get big and the revenue gets big, and the success and failure outcomes, change everyone's careers.
Definitely agree. And I also think most of the major players are obviously thinking about that. And we also had some major announcements. I think it was in 2026 already with New York Stock Exchange and NASDAQ wanting to tokenize shares. So the ship is already moving. It's just a question of when the dam is going to break, right?
Everyone wants to, right? NASDAQ wants to, New York Stock Exchange wants to, Coinbase wants to, Kraken wants to, Binance wants to. I mean, everybody that has an order book wants to be trading tokenized securities, period. Right? How could you not, right? How could you not want your order book to include tokenized securities, right? If you're a traditional stock venue like NYSE or NASDAQ, you want tokenized securities because instead of T+1 and these giant batch settlements at the end of the day that are done through DTC and all this complexity, it could just be ongoing in real-time constant settlement. That's an incredible upgrade. And if you're a new world venue, if you're a crypto exchange, like a Coinbase, a Kraken, a Binance, whatever, it's a new opportunity for you. You don't have to look at just the 2.5 trillion of crypto as what you can trade. You can look at the 700 trillion of everything that you could trade. And that's compelling. That's really compelling.
And a quick note before we continue. Proof of Talk is back. June 2nd and 3rd at the Louvre Palace in Paris. 2,500 digital asset leaders, 85% decision makers, 18 trillion in asset under management in one room. Sold out 2 years running. I'll be there personally, and 51 Insights is the official research partner this year. If you care about the institutional side of digital assets, this is the room you want to be in. Proofoftalk.io, link in the show notes. All right, let's get back to it. All right, so let's jump into the Invesco deal. That's a deal that you announced, or a partnership that you announced 2 days ago. Can you walk us through what that actually means for Superstate?
Absolutely. In a lot of ways, there's 2 announcements that we've made with them over the past couple of weeks. They're not cause and effect, but they're, intertwined in some ways. But what we announced is that, we are going to be making Invesco the first incumbent asset manager with a product on the Superstate platform. In conjunction, they are also investing in Superstate, or have invested in Superstate. This is exciting. So when we built Superstate, again, this is, we go back to mid 2023, it was the Gary Gensler era, nothing exciting was being allowed through the gates. If we went and pitched Invesco on launching a tokenized fund with Superstate, we probably would have been laughed out of the room. Or it would have taken a long time to work through all the different meetings we would have to work through, right? So what we did as a platform is we said, we're going to launch our own products. We're going to launch our own tokenization technology. Our own products, like a Superstate T-bill fund is going to be the first asset we tokenize. A Superstate, basis high yield fund is going to be the next product we tokenize. We started off by building our own products as an asset manager to live on the Superstate tokenization engine. And so Invesco's our first opportunity to shift from being hey, it's Superstate proprietary products that we made and we're tokenizing, to, okay, this whole time we've been able to work with third-party asset managers and tokenize their products. The game has shifted. And so for us, what we're doing is we're actually starting this off or accelerating it by converting Superstate USTB, which is our, money market fund, into Invesco USTB. It goes from being Superstate's name on the product to Invesco's name on the product. Instead of we being the asset manager, they're the asset manager. But what doesn't change is that it's running on Superstate's tokenization technology platform. And what we're swapping is it's our own products for someone else's products. And so, it's exciting. I think, we're going to use this to prove how tokenization works for one of Wall Street's largest asset managers. I, don't have any alpha to leak, but I can imagine that, it facilitates us launching more products together at some point, I hope. And, hopefully it demonstrates for other asset managers as well that, tokenization can work even for the largest incumbent asset managers. I hope this is in a lot of ways a watershed moment. There's a lot of interest from asset managers to come on chain, and this is us finally opening our platform to those asset managers.
Can you also help us understand a little bit the size of these funds and these deals compared to the whole Superstate platform?
The size is significant. So, we currently have two funds on the platform, USTB, our money market fund, and USCC, a higher yield basis product. USTB is about $850 million of AUM. So that's what's going to go from being a Superstate product to becoming an Invesco product. But that's like the right way to bootstrap their product. They get to start with a tokenized security at $850 million. And so for us, it is significant. For them, it's significant. We're not talking about, tiny products. We're talking about products that are at the $1 billion tier. USTB fluctuates around $1 billion. It's a real product. And so, I'm really excited by the fact that, we can make this an Invesco product and, have a third-party asset manager on a daily basis, every single day, having a product operating on the Superstate tokenization engine.
And can you unpack for us right now? So those funds are tokenized. What does this unlock right now?
It actually unlocks a lot. And I think people don't notice how many things that it unlocks because they just see like, oh, it's tokenized. So, that means I can hold it in my wallet. Yes, you can hold it in your wallet. If you're a crypto native investor, if you're a hedge fund or a venture fund operating in the space, you can hold it in the same wallet that you hold your other crypto assets, right? You can hold it in the same, custodian that holds your Bitcoin or your Ether, right? Like that's cool. But that's just like the first difference, right? There's a lot of differences between, a traditional product and a tokenized one. And I'll start with describing our money market fund, USTB, because, it's easiest to understand an off-chain T-bill versus an on-chain one. So an off-chain T-bill, you earn roughly the, Fed funds rate minus some costs, and that's it. Like the on-chain version of that same thing happens. But instead of that interest accruing by the day or by the week, right, it actually accrues in real time. Why? Because the product's built on blockchains and a very modern back end, and blockchains don't work by the day, right? Legacy financial products work by the business day. Nothing on a blockchain operates in business days. In fact, most blockchains don't even have the concepts to be able to support that. And so with USTB, this, tokenized money market fund, interest actually is calculated and accrued, in real time or by the block. It's powerful. It's cool, right? Does it change your economics if you hold it for a year on either side? No, not at all. It doesn't. Like you earn the same interest whether you held it, in crypto form or traditional form. But what it enables is you to do intraday transactions without either party to it, losing interest or gaining interest outside of what's expected. So what it enables is, me and you to transfer this token between us at like either 2 a.m. or 9 a.m. or 4:15 p.m. or, 7:22 and 19 seconds p.m., right? And the interest is calculated perfectly. And it facilitates intraday movements. That's the first major change. The second major change is because of that, you can use it as collateral really efficiently. We've seen USTB and tokenized products being used with, institutional counterparties. Like if I'm doing a derivatives trade, I could use it as collateral. And instead of posting a stable coin to you, I could post tokenized T-bills. We've seen it being used as collateral in DeFi protocols. Aave Horizon on Ethereum, Camino on Solana. These are like the two biggest ones that we've seen adoption in. But there's people using it to borrow stablecoins of multiple different denominations on a moment's notice. That's literally like supply to the protocol, take stablecoins out, go about my way without selling it. That collateral use case, especially because you can move it around intraday, is like really powerful. In addition to that, like we've seen, embedded programmability. So, if I wanted to build my business around some off-chain security today, it's really hard. But if you want to build a DeFi protocol or product on top of a tokenized security with like real-time mint and burn, it's actually doable. And so there's a number of DeFi projects that have like been building on top of USTB as just this programmable yield building block. And that's something that you can't do with off-chain securities. I mean, like, the business contracts that you'd have to write alone would take you like months, right? Let alone like the implementation, like none of the systems off chain in traditional are like even set up for programmability. But when it's tokenized, all of that changes. Like you literally have like DeFi teams, just building this into their own products as like a source of yield. And like that programmability just doesn't exist in traditional analogs. And those are like the most important use cases. The last piece of it is just there's different investors, right? It's like if you are a crypto native, like hedge fund, let's say, knowing that you can like enter and exit this intraday, you might actually use it, as part of your like trading workflows. You're like, okay, if I sell Bitcoin, sell it at the stable coins and then instantly convert it into USDB. And when I want to buy Bitcoin again, like after the trade closes, it's like, okay, well, convert the USDB back to stable coins and, use it to fund my purchase. But all of that's facilitated by the fact that it's on chain and it's real time.
That's super exciting. I mean, all of these use cases are more a revolution than an evolution, actually, for trading in stocks. And if you look at the DeFi part specifically, where do you think we are in terms of actual institutional traders operating on DeFi and using that stuff versus crypto native single users who are just experimenting right now?
I mean, it's clearly like we're starting to see a lot of institutional use, right? So Superstate, almost our entire user base for USDB and USDC are institutions. It's a very institutional crowd. And the reason is because these are structured as private funds today. They're not ETFs, they're not things that like everybody has access to. They're still only for, institutions. And so like not a single retail user of these. We're past the $1 billion mark and there's not a single retail. That's cool, right? So I could say at least with our products, it's all institutional. Like what types of institutions? I mean, it varies, right? Some of it's like crypto hedge funds. Some of it's, a venture fund. Some of it's, an offshore foundation operating a protocol that builds on top of it, right? It's a variety of different types of institutional investors, but they're all institutional in terms of their definition. And so that's what we see in our products. Do we see institutions like trading these in like DEXs and things like that? Not really, not yet. Do we see those same, customers, interacting with like other types of DeFi protocols and systems and activities? Like a little bit, like maybe, not Superstate products, but like we see those same folks because they're early adopters of things generally, they're using new products. But all of this is growing every single year. And so, I think if you ask the same question again in a year, the answer is going to be like, yeah, well, there's even more use cases that are starting to really scale.
Robert, one of the products that you also released recently is the opening. You call it opening bell. It's pretty simple. It says go public on chain. That's the idea. Can you just unpack that for us a little bit? What does this mean and why did you launch this?
So opening bell is our, stock and, equity tokenization platform. So, we've built up the technology to tokenize both funds and equities. There are differences under the hood. Like the way that an equity works is very different than the way a fund works. A fund has subscriptions and it has redemptions and the number of shares goes up and down every day. An equity is complex in different ways, right? You can't easily buy it and sell it or create and destroy it. You're like, there's generally a fixed number of shares. And those shares have dividends. They have corporate governance and proxies. They have stock splits. They have all these things that like funds don't have, right? So they're similar but different. And so there are two different approaches to tokenizing securities. But with Opening Bell, this is what we use to tokenize equities. And we work with public companies. We are not working with private companies yet. This is just for public companies that are registered and, are publicly traded or able to be publicly traded. And so Opening Bell, right now, all of the issuers that we're working with are generally like NASDAQ traded companies. This is our approach to tokenize their shares so their shares can be tokens on a blockchain. They're on Solana and Ethereum. They can move around on Solana and Ethereum. They can be collateral on Solana and Ethereum. If there's corporate governance, things, if there's dividends, if there's stock splits, all of that's, handled within, the tokenization processes. And it's a public company shares as a token in a wallet. And it works. It's phenomenal. We're going to be expanding that into capital formation. And so there's a little bit of a double entendre of like go public, on chain, which is like you're taking public companies and you're putting them on chain. But also, we expect that public companies are going to be able to incrementally raise capital on chain. We haven't seen too much of this yet just because, we haven't seen too many public companies in general become tokens. But the biggest advantage, to go all the way back to our conversation of like, what's the difference between native issuer-led tokenization, which is our approach, and like a wrapper where someone goes out and buys shares of a company. The biggest difference is in capital formation, in that when it's the company's official shares, they can sell them to raise money, to fund the business, to grow the business, to add a warehouse, to add a data center, to add a marketing campaign, whatever. This is going to be the year where we start to demonstrate and test how public companies can raise capital using tokens.
And to play the devil's advocate here, like if someone told you, yeah, we already saw this like 10 years ago with ICOs, what's the difference between ICOs 10 years ago and what you can do today on Superstate?
Yeah, absolutely. It's a great question. So with an ICO, it was, hey, I'm going to make, a token, right? Which is not like a registered security. It's just a token, right? And I'm going to sell that token to the public, and you're going to give me the proceeds, and I'm going to try to start a crypto project with it, right? Two differences. One is like, it's not like a security, and it's generally as early stage as it gets. ICOs were mostly at the very outset of a project where there was nothing there, right? Public companies tokenizing their shares and raising capital is kind of the opposite in both ways. So the first opposite is that these are public companies. These are companies that are already trading on the NASDAQ and the New York Stock Exchange. They're registered companies. They do quarterly financials. They're audited. They do all their 10Qs, right? These are like the big boy companies, right? They're registered. And they're not early stage. These are like companies that have already gone through the slog of like delivering something to the point where they are public companies, right? And so in two ways, they're kind of the opposite of ICOs. One is like they're registered securities. They're not like crypto tokens. And two is that they're late stage versus early stage. Both of those major differences. And so think of this as like the stock market coming on chain, but in like primary capital. Most of the trading that happens is secondary. The shares already exist. You're just trading them, back and forth between a bunch of different people. Bringing primary capital formation on chain, a little bit out of the hands of the investment banks and into the hands of blockchain users.
Yeah, that's great. And I just wanted to make sure that distinction is super, super clear. So Opening Bell, very interesting product. I think one of the most interesting case studies you did with Forward Industries and Camino and that integration that you did. So super interesting. I think that's really like a public company's SEC registered shares posted as a collateral on a Solana lending protocol, correct?
It's really cool. I mean, at this point, I haven't checked in a few days or weeks, so my numbers could be a little bit off, but like about 8% of the company is tokenized. Of a whole public company, right? This is like Solana's largest treasury company. Almost 10% of the company shares are tokenized on, through Superstate. That's really powerful, right? Just to think like, the magnitude and the impact of a company. Like if, 8% of like Amazon were tokenized on a blockchain, people would be like, oh my God, like the blockchain is like the future, the entire thing is being used in this productive way. A very significant portion of like the forward cap table is tokenized through Superstate. And from there, it's being used as, collateral in Camino and as collateral through, other arrangements, not necessarily using DeFi protocols. It's remarkable. And I think it's like actually the first like major example of a significant portion of a company's shares being used productively on chain.
All right. So Robert, I also want to talk a little bit about regulation. We have the Clarity Act that's still stalled in Congress. We have Chair Atkins with the project Crypto actively working on a tokenization framework. We have Commissioner Pierce, Crypto Task Force that is writing a token taxonomy. What rule change, what legislations are you looking forward to with most suspense because it would unlock the Superstate business model even more?
Absolutely. So, I have two hats. One is I've been a member of the crypto world for a long time. As a person, I am most looking forward to the Clarity Act. As Superstate, I am most looking forward to some of the things coming out of the SEC in relation to Project Crypto. And what do I mean by this? So the Clarity Act defines, especially for the hundreds of thousands of tokens that have been made over the last, decade plus, when are they securities? When are they not securities? What's the difference? And what that's going to do is it's going to give, a lot of comfort to institutions entering trading, entering custody, entering brokerage, that want to interact with crypto assets, right? Not tokenized securities, but like crypto assets. It's going to be the thing that I think gives every single incumbent comfort moving into this market. And there's going to be a lot more competition for crypto trading and custody and settlement and creating new products. And that's a good thing. But it's going to be the green light for everyone to go into crypto, right? It doesn't really change tokenization much. Then there's a lot of the work that the SEC is doing on, Project Crypto or an innovation exemption. There's a few different phrases for this, and nobody really knows exactly what they're going to entail, what the structure is going to look like, what's going to be included, what's not going to be included. We're all sort of waiting with bated breath. But the one thing that I feel pretty confident about, because it's been said publicly so many times, is that, Project Crypto and the innovation exemptions are really going to be around, tokenized securities. And, what happens not with the, crypto native non-security tokens that are talked about in Clarity, but what happens with the stocks and the bonds and the real estate and all the things that people want to bring on chain. What are the rules for it? Because right now there's a huge amount of rules around how securities work. The SEC's job, for the most part, in its existing role, is to dictate how securities work, right? And exchange. How does that apply to blockchain, right? That's the part that hasn't really been written or hasn't really been figured out yet, right? There's 100 years almost of figuring out the rules for how a stock trades on an exchange, right? And the brokers that interact with it and what you can do and how you market it and all of these different things. Bring that on chain. There's a lot of square peg round hole things, right? There's a lot of arcane things that aren't even possible because it's on a blockchain, or are now possible on a blockchain and deprecates a lot of the rules that were created because these incredible technologies never existed. And so Project Crypto, I think, is going to have the biggest impact on tokenized securities, their role in the world. It's, I think, going to take a lot more energy and time to figure out the things, because tokenized securities have only been a conversation in society for about a year now, right? But we've had over 10 years of people saying what's a security? What's not a security? When is it? When is it not? How does this work? Is it legal? Is it legal? Right? So I think we're much earlier in the tokenization conversations from a policy perspective, but that's going to have a huge impact on how Superstate grows, how the market grows, and it's going to shape the future.
Robert, you're the man in the arena. You're building the actual infrastructure, the stuff people use. If there's one message you could give to corporate leaders, executives, thinking about these solutions, trying to figure out how they can start tokenizing stuff and actually building a business out of that, what would that message be?
Yeah, my message is, blockchain and crypto are incredibly good tools for assets, right? Fundamentally, the magic innovation of Bitcoin was, instead of everybody having their own spreadsheet and view of who owns what, we finally, for the first time, had a shared, transparent ledger of who owns what. And Bitcoin proved that it was an incredible way to record assets, point blank. And no one should be afraid of that ledger technology to record assets. It works at scale. It's robust. It is incredibly sound. It is very hardened and resilient. And it's a much better way of recording who owns things than the spreadsheets and databases that are scattered everywhere in traditional markets.
Robert, a great ending. Thank you so much for coming on the show. We're already at time. Where can people learn more about you, about Superstate?
Yeah, superstate.com if you want to learn about Superstate, and you can follow me on Twitter at @rleshner.
Robert, I wish you all the best with Superstate, and talk soon.
Appreciate it. Thanks for having me on the show.
You obviously liked this video enough that you got to the end. Listen, do me a favor, hit that like and subscribe button because I think you'll like it. And if you want even more, with more I mean incredible alpha, research, and digital asset market updates, subscribe to our newsletter on 51, that's the number 51, insights.xyz, and get the most actionable insights on digital assets. See you next time.